Hey, it's Coach Hirsch. On this learning station number 5, we're looking at the Federal Reserve in action. In station 4, you looked at the components of the Federal Reserve, what makes it up, the Board of Governors, the Reserve Banks, the FOMC, and things like that. Now we're going to look at how they create policy to make changes in the economy. This is station 5 again. It's just a page for notes. So as I move through the PowerPoint, take some notes down. If you have any questions, of course, ask me or Ms. Rosenfeld, and we'll be happy to help you. The first thing we look at is what is monetary policy? What does monetary policy mean? Monetary policy is changes that affect the nation's supply of money and credit. And the actions that come from monetary policy have real short and long-term effects on the economy, which we'll look at. First of all, there's 3 goals of monetary policy. Full employment. As we learned in the previous unit, full employment is basically between 4 and 6%. And when we say full employment, that's also synonymous with the target unemployment rate. So if you hear the economy is in full employment, think 4 to 6%. If you hear, hey, the unemployment rate is great, think it's between 4 and 6%. So they're basically kind of synonymous with each other. The next one is stable prices. We don't want prices to be too low, because if prices are too low, people spend a lot of money and inflation will rise quickly. And we don't want prices to be too high, because then consumers can't spend money. They can't afford it. So we want stable prices. And then the last one is sustainable economic growth. When we study GDP, we don't want our economy to shoot up on a chart. We want it to grow steadily and consistently as we move from quarter to quarter and year to year. So there's 3 main tools of monetary policy and of the Federal Reserve. The first one is the discount rate. This is the interest rate charged by the Federal Reserve to banks that borrow on a short-term basis, and usually on an overnight basis, and they borrow it today and they pay it back tomorrow. And when we say interest rate here, what we mean is that the Federal Reserve is borrowing this money and they have to pay, a fee, the interest rates, to borrow that money. And if the interest rate is low, then banks are more likely to borrow because it costs them less money. And if they're less likely to borrow, then they're more likely to borrow. They'll get those loans and provide those to the businesses and consumers. If the interest rate's high, they're less likely to borrow. So that's a very key tool. The next one is reserve requirements. The amount of money banks keep on reserve at the Fed or in their vaults. So if you think about the movie where bank robbers break in and there's pallets full of cash in the bank vault, that's basically the reserve requirement. They have to keep a percentage of their deposits in their vault. And primarily they do that because that affects the money supply. So if there is a lot of money that's required to be in the vault, that's less money that can be loaned out. If there's less money that's required to be in the vault, then that's more money that can be loaned out. And we'll look at how that works here in a minute. And then the last one is arguably the most important one, which is open market operations, and that's the buying and selling of bonds. So when the Fed buys bonds, they're giving cash for bonds, and that increases the money supply. And if they sell bonds, they are giving bonds to people in exchange for cash, and that decreases the money supply. So let's look at how these work in creating policy. So the first thing is when we talk about interest rates. So when interest rates are low, it stimulates the economy because there's more money available to lend. Consumers buy cars and houses, businesses expand, they buy more equipment, they hire more people, they open new locations. Why does the Fed lower interest rates? If inflation's in check, meaning that it's really not going up, it's really not going down, the lower rates will stimulate the economic activity, easy for me to say, thus boosting economic growth. So in other words, if prices aren't rising, the Fed says, well, if prices aren't rising, that means that generally suppliers are not supplying a lot. So therefore, if we lower the interest rates, people will borrow more money, they'll start to spend, and when they spend, suppliers will eventually start raising their prices, and thus inflation would go up. The effects of high interest rates. Well, if the interest rates are high, it's obvious it's the opposite of the lower interest rates, right? People are less likely to borrow. It's more expensive to borrow, so consumer spending slows down. And as a result, businesses have a difficulty borrowing because it costs them so much, and they may have to lay people off, so unemployment goes up. So 2 policies here that the Federal Reserve employs. Easy money policy, which is code for increasing the money supply. How do they do that? They lower the reserve requirement. Why? Less cash in the vault means there is more to loan to businesses and consumers. More loans to businesses and consumers equals more spending, which equals an increase in GDP. If they lower the discount rate, why? Lower interest rates means that banks pay less to borrow and equals more loans, which in turn equals more spending. Buying bonds increases the money supply as the Fed exchanges cash for bonds, which equals more money in the money supply and more spending. So all of these help to increase inflation slowly, because if there's more money in the money supply, there's more money floating around out there in America, then means that prices start to go up because people are spending more because they have more money to spend. And the opposite would be tight money policy. We decrease the money supply. How do we do that? Well, we raise the reserve requirement. Why? If there's more cash in the vault, means there is less money to loan to businesses and consumers. Less loans to businesses and consumers equals less spending, which equals a decrease in GDP. The next step, raise the discount rate. Why? Higher interest rates means banks pay more to borrow and equals less loans because they don't want to borrow it because it's going to cost them too much money. So then, therefore, those loans don't go out, which means there's less spending. And then the last part is selling bonds. Selling bonds decreases the money supply as the Fed exchanges cash for bonds, which means there's less spending. All of these help to decrease inflation slowly. So it's one of these things where the Fed is trying to counterbalance. So they can be doing easy money policy at one point and then tight money policy at one point and then easy money policy and then tight money policy, and just trying to keep prices stable and full employment and sustainable growth. So I hope this provides an overview for you on how the Fed employs monetary policy to affect the economy. Again, if you have any questions, please let me or Ms. Rosenfeld know.